All right, we have more changes unfolding in the U.S. economy and over at the FOMC. Changes that have FOMC voting members now treading cautiously, preparing for the lag effects that accompany tighter monetary policy, tighter lending standards, and these significantly higher rates. As the chairman of the Federal Reserve, Jerome Powell, spoke yesterday answering questions at his presser, and some of his responses were telling, were, let's say, interesting. A few of them in particular, and one in regards to the housing market, in which he seemed to slip up in the answer that he gave, where he all but says that they are seeing a significant housing downturn coming. So we're going to listen to exactly what he said, what he's referring to, also why the FOMC decided to do what they did yesterday, holding the overnight rate unchanged, because there's one report that these FOMC members get to see prior to each of these votes, a report that sways their decisions and is vital for this current economic cycle that we're in, and it's released publicly days after the meeting. But before we get started, press the like button and consider subscribing. It helps me out, and I appreciate your support. So the Fed, folks, the U.S. Federal Reserve just commenced their November FOMC meeting, a meeting in which almost all investment banks and analysts correctly predicted would result in a pause of the overnight rate, holding it at 5.25 to 5.5%, which is fine, as it's not so important that they continue hiking. What's important is that they don't cut rates anytime soon. As much as these Wall Street analysts and Wall Street in general hates that thought, absolutely despises the thought of the Fed remaining in restrictive territory, it's necessary, absolutely necessary to prevent runaway inflation and to deflate this everything bubble that we've been living in now for years. And their loathing seeps through in these investment bank reports that I read. You can see it trickle through even to broad-based financial media, and even at the press conference that Jerome Powell held yesterday, pushing him for reasons why they can't cut rates yet. Well, take a listen to Big Daddy Powell. Listen to his response to a question on cutting the overnight rate. Here he is. Take a listen to this.
What then is the potential impact on the trajectory of rate cuts? Could we see those maybe pulled forward or have to see more than what the September SEP indicated?
So it's the fact is the committee is not thinking about rate cuts right now at all. We're not talking about rate cuts. We're still very focused on the first question, which is have we achieved a stance of monetary policy that's sufficiently restrictive to bring inflation down to 2% over time, sustainably? That is the question we're focusing on. The next question, as you know, will be for how long will we remain restrictive? Will policy remain restrictive? And what we said there is that we'll keep policy restrictive until we're confident that inflation is on a sustainable path down to 2%.
Now, there's no way to tell if he's genuine in these answers, but why it's so important that what he just said is in fact what's really happening is because the lag time for the Fed's tightening campaign is taking longer than they'd originally thought it was, but it's beginning to show up in the data. We've explained in prior videos how this is a waiting game, folks. The Fed has done their work. They raised the overnight rate to a restrictive level and are continuing the process of QT, quantitative tightening, where they're unloading their balance sheet, shedding $60 billion per month in treasuries and in mortgages, a key reason why the banks are now forced to tighten their lending standards, which they are doing, have already done in a significant way, which you can see on this chart. Virtually as tight today as it was back in '08. What this shows is banks' willingness to lend you money. The higher the line goes, the more unwilling they are. You could see it for corporate loans and for CRE loans, commercial real estate loans, both of which are significantly more difficult to obtain right now today than they were just 18 months ago. And this is what we're waiting to see, folks. SLOOS, the Senior Loan Officer Opinion Survey. This is the report that the Fed gets to see before all of us and before each and every FOMC meeting. They purposely schedule these meetings so they get the results back beforehand, and in normal times, it barely changes. In fact, lenders normally try to loosen policy, and the Fed and regulators want to try to make sure that they don't loosen standards too much, like we saw them do in the years preceding the great financial crisis, handing out loans like candy. But today, right now, isn't a normal time. This is a period of financial belt tightening, something that happens so rarely that it's fair to call it an extraordinary period of time. And when this report drops, we're likely to see that the banks continued tightening lending standards even further than this chart shows here, which would explain the Fed's decision to hold the overnight rate steady, hold it where it is at this 5.25%, 5.5% range, as tighter lending standards are even more potent a tool than rate hikes are. They cause everyday people to hold off on big discretionary purchases like buying new cars or whatever, and cause businesses to grow slower or even contract. You can't start big new projects without financing, right? And the financing, the credit that you need is gone, folks, all leading to a slowdown in unemployment, or a slowdown in employment, or higher unemployment. Take a listen to Jerome Powell himself explain this at yesterday's press conference. Take a listen to this.
But since the economy has not responded to rate hikes in ways that would normally be expected, have you changed your views on that at all, on how necessary or inevitable that kind of pain would be, say, for the labor market or overall growth?
I still believe, and my colleagues, for the most part, I think still believe, that it is likely to be true. It is still likely to be true, not a certainty, but likely that we will need to see some slower growth and some softening in the labor market, in labor market conditions, to get to fully restore price stability.
Now, thus far, we haven't seen the labor market crack. The unemployment rate did bounce off its lows to 3.8%, but this can change promptly, suddenly. And when or if it does, if we were to see a spike in unemployment, which you just heard the chairman of the Fed say he wants to see in watered down language, realize he can't come out and say he wants to see the labor market break completely or waves of layoffs. That would be politically untenable, but he most definitely does want to see something like that. What he actually wants is to see this number return to what they call the natural rate of unemployment, or the rate that occurs when the market is at equilibrium, when supply and demand in the labor market is in balance. Now, he said that we're getting closer to that rate, but like you just heard him say, we are still far off from it. And that's the crux of the issue here. Just how big of a slowdown are we going to see? Well, in the coming quarters, many analysts, not the garbage analysts that you read in financial media that say that we're constantly in a bull market, but the ones who are right a high percent of the time, like B of A's chief financial strategist, who believes a hard landing is likely and the next few quarters are going to be rough. For example, like you see here, if we jump over to the auto loan dashboard, which if you want access to, by the way, the link is in the description to our website. But if we look at this, and again, auto loans are just one indicator, but it's now showing up in the data across the board, folks. First, take a look at auto loans. We now have negative auto loan growth for the first time since 2008. This is actual auto loans, not banks' willingness to lend, actual loan originations. Now, negative, how about auto loan rejections? Lenders rejecting applied fors beginning to spike. This is what it looks like when banks tighten lending standards. You go to get a loan and the bank says no, right? You try another bank, that bank says no too. Only the best of the best borrowers with great credit profiles can qualify. Everyone else gets rejected, like we see beginning to happen. And if we scroll up here in the University of Michigan's Consumer Sentiment Survey, the reason why most people say now that they're choosing not to buy a new vehicle, what's the reason? Interest rates. The rates are just too damn high with prices where they are. Nobody wants to spend $800 a month for a Toyota Corolla. The point is, it's working. What the Fed has done is beginning to work. All that's left to do now is to wait until the lags reach enough of us, enough businesses to pop the unemployment rate and trigger the hard landing. Now, Jerome Powell actually explained this yesterday in his presser. And don't worry, we're going to get to the housing market as well, because he said something extraordinary about housing in that press conference yesterday. But first, take a listen to what he says about lag time. Here he is. Take a listen to this.
At this meeting, 1 year ago, this was the fourth of our 75 basis points hikes. So that's a full year since then. I think we are seeing the effects of all the hiking we did last year, and this year we're seeing it. It's very hard to know exactly what that might be. But you can, for example, an example of where you wouldn't have felt this yet is debt that had been termed out. but it's going to come due and have to get rolled over next year or the year after. So, and there are little things like that where the effects are just taking time to get into the economy. So I think we have to make monetary policy under great uncertainty about how long the lags are. I think trying to get a clear answer and say, I'm just going to assume this is really not a good way to do it. And this is one of the reasons why we have slowed the process down this year, was to give monetary policy time to get into the economy. And it takes time, we know that, and you can't rush it. So slowing down is giving us, I think, a better sense of how much more we need to do if we need to do more.
Now, he's specifically referring to all those floating rate loans, right, that are out there, which have yet to mature. He says that the loans haven't termed out yet because most corporate loans have floating rates. And there's this wall of maturities coming in 2024, 2025, 2026, actually for the next 5 years. But we'll begin to see them really pick up in 2024. And when that happens, all those businesses will go from paying a few points in interest to 8, 9, 10, maybe even 12% in some cases, leading to a percentage of them, not all of them, but a percent of them, not being able to pay and forced to conduct layoffs, default on said loans, or even go out of business entirely. Now, the most interest rate sensitive sector of the economy, we all know what it is: real estate, CRE, and the housing market. Well, the latter, Jerome Powell addresses directly in this press conference, and he appeared to slip up a little bit, saying something in which, if you weren't listening carefully, you may have missed it. But take a listen to this. He responds to a question that wasn't about housing at all. A reporter was asking him to justify how he knows any of this tightening is even working, why he's confident that all of this will even slow above trend growth when it hasn't done so yet. But take a listen to his answer. Here he is.
What makes you confident that tighter financial conditions will slow above trend growth when 500 basis points of rate hikes, QT, and a minor banking crisis have not thus far?
Well, that's the way our policy works is, and sometimes it works with lags, of course, which can be long and variable. But ultimately, if you raise raise interest rates, you do see those effects, and you see those effects in the economy now. You see what's happening in the housing market. You're seeing that now. You'll see, if you look at surveys of people, it's not a good time, they think, to buy durable goods of various kinds because rates are so high now. I mentioned again, we're getting reports from housing that the effects of this could be quite significant. I mentioned again, we're getting reports from housing that the effects of this could be quite significant.
He says we're getting reports from housing that the effects of this could be quite significant. Look, the bottom line is it's working. We looked at data from the auto sector briefly, but it's showing up across the board, folks. And unfortunate as it is, once the Fed gets what they want from the labor market, we'll start to see more and more homeowners begin listing their properties, not because they want to, but because they need to. All right, if you enjoyed this video, got something out of it, press the like button. If you didn't, that's all right too. Either way, I appreciate you watching.